Cool. So the plan for this evening, we are going to cover tasks 5, 6, and 7, a bit tax planning, a bit capital gains, and a bit national insurance, which will cover 24 marks, which is roughly a quarter of the 100 marks available. So we're on course, and then we'll do some more capital gains and some inheritance tax on Monday evening, because we all love inheritance tax. So the first one, task 5, is about national insurance. Now, the thing with national insurance is don't learn the rates. Life is far, far too short. They change every year. You just don't know. The reference material is your friend here. So what we get, Ben's been given a gross salary of £50,500 and taxable benefits of £16,250. None of these taxable benefits are convertible into cash. Therefore, they are not going to come under class 1 primary. So typical sort of question, we've been asked for class 1 payable by Ben, class 1 payable by Ben's employer, and class 1A payable by Ben's employer for class 1A. So Ben, what will he pay, class 1 primary or class 1 secondary? Hang on, that's right. So if we look at our reference material, it does say here, I mean, it does say who pays it here, but this one here is class 1 primary. And now in our notes, it doesn't say Ben's age. Now, if Ben was over the state retirement age, he wouldn't pay class 1 primary, but in your exam, they're all going to be paying, well, be under the state retirement age, because that's a boring question. So always assume that they will pay class 1 primary. So it will be based on 50,500. So again, like I say, don't learn the rates. Life's too short. So the first 9,568 is assessed at 0%. So 9,568 at 0 is obviously 0. Now, obviously, you wouldn't do that in your calculations, but we'll do it properly. We then are going to look at the next one, where typically most people start paying at a rate of 12%. Now, it's 12% between £9,568 and £50,270. Now, I'm sure this was deliberate. His income is just over. So between 50,270 take away the 9,568, which has been assessed at 0%, gives you a figure which, to be honest, if you've done loads of these questions, you should know this figure off by heart, because they'll try and get someone who earns over the 50,270, because then it makes the questions a bit more interesting. 568 gives a figure of 40,072. That's 702, sorry, and that will be assessed, not taxed, at 12%, which is a figure of 4,884, rounding to the pounds. We then need to assess the balance, so that'll be the 50,500 less the 50,270 that we've already assessed. Is figure of £230, which is assessed the upper limit for, well, the upper rate, sorry, for employees, which is a rate of 2% times 0.02 gives a figure of 5. So the 4,884 plus the 5 gives a figure of 4,889. Yeah, as Hannah says. Everyone are happy with that? So now we're going to look at the ones, the national insurance payable by his employer, the class 1 secondary. Now this is a bit more straightforward, but it is a different figure. So it's 8,840. So the first 8,840 is at 0%. And then the difference, so if we take the 50,500, take off the 8,840, is of 41,660. And what rate do we assess that at for employers? Yeah, so times 0.138. Make sure you do your equals first, times 0.138 gives a figure of 5,749. Now remember, there is no upper limit on this, it's just 13.8% for everything. So that gives a figure of 5,749. And then just as well, it did say ignore employment allowance. Now, if you get a question which starts saying things like it's a limited company and there is one employee or there is two employees, what is it getting at? You know, yeah, it's about it. What sometimes it might not prompt you about the employment allowance. So the rules are, if it is a limited company with one employee, you cannot claim the employment allowance. Anything else, a limited company with more than one employee, or a sole trader, or a partnership with any employees, you can claim the employment allowance. It is just if it is a limited company with one singular employee, you cannot claim the employment allowance. And the last one is the class 1A payable on the benefits in kind. Now, there is no amount assessable at 0% with benefits in kind. So it's 16,250 times by 13.8%. I mean, you could check the reference material, but it is 16,250 times 0.138 gives a figure of 2,200, we'll round that up, 2,243. Cool. And that is our question. So that, how much did we get? 7 minutes. Do you reckon on a good day with the reference material, you could do that in 7 minutes? Yeah, it's not too bad. I mean, there is literally only 3 things in it. Class 1A, Class 1 secondary, and Class 1 primary, Class 1 secondary, and Class 1A. And it's just knowing, you know, if it's convertible into cash, it is, you know, Class 1 primary. If it's not, it's Class 1A. And just use the reference tool. Yeah, it's, you know, you should be looking for good marks on national insurance. It is one that students do well, but like I say, don't learn loads of stuff. Use the reference material. Cool. Any questions on national insurance before we move on to what's the next one? I think it's tax planning, which is my favorite one if I had to choose. Well, second favorite one after tax comes. Right, I'll take that 6 seconds as a no, and move on. Now, yeah, employment allowance is, there's just basically one rule. If you a limited company with one employee, and you'll have to tell you the number of employees, you cannot claim the employment allowance. If it doesn't, if it is a limited company with more than one employee or sole trader partnership, you can claim it. Always go to claim it unless it says ignore the employment allowance, because they'll be looking to see if you know it and know of its existence. That comes off the Class 1 secondary payable by the employer. So it can come off the salary amounts, it comes off the national insurance once it's calculated. Cool. Right, tax planning, one of my favorite ones. So we've got some true false ones and we've got some calculations. And I'll show you a couple of ways. Well, one way you can maybe save a bit of time with this, but being careful. But let's do our true or false ones. So Reggie's total income of £105,000. If he puts £5,000 into his personal allowance, it will reduce his adjusted net income to £100,000 to preserve his personal allowance. Is that true or false? So if we put £5,000 into a personal pension, will we take his income down to £100,000? Because then he hasn't got that, you know, every £1 off for every £2 over. Now, lots of people saying false. Why is it false? Oh, well, also why you say it's false, I should say. for top marks? Yeah, Helen, yeah, and Hannah is top marks. That's right, because his pension would be net of 20% tax credit. So we need to reduce his adjusted net income by £5,000, and we will reduce it by the gross amount. So £4,000, if he puts that in, we will then gross this up by 100 over 80. Well, I wouldn't, I'd just divide it by 0.8, would mean actually his gross pension contribution therefore would be £5,000. So he only needs to put £4,000 in to reduce his adjusted net income to £100,000. Now he could put £5,000 into his personal pension, and that would protect his personal allowance. But that would, if you divide it by 0.8, it would mean his gross figure would be 6,250, meaning his adjusted net income would be £98,250. Does everyone follow why he would only need to put £4,000 in? Well, it doesn't matter if you got the wrong reason, because it's true false. If you'd left it false, you would have got the marks. But don't worry about it. I mean, likely, you know, if he'd put £5,000 into his personal pension, it would actually have reduced his if he put £5,000 into his occupational pension, it would have reduced his adjusted net income down to £100,000, actually, to be fair, Kirsty. So that is another reason why it is wrong. Remember, with an occupational pension, the tax savings given at source. So it would be just £5,000 off his salary of 105. But either way, it was the right answer, so it doesn't matter. Cool. Next one. Paul is provided with a company car for 2122, and his employer pays for both his private and business fuel. Now, Paul needs to reimburse his employer for all the fuel provided in order to avoid a taxable benefit on the fuel. Is that true or false? We've got a true, we've got a false, we've got a true. Anyone for anything else? Hannah is the one that involved it. When I saw this question, I didn't like it. I thought that's just getting it, being a bit picky, really. So as long as he reimburses all the private fuel, there is no benefit in kind. Expecting to pay for business fuel is a bit off, really. But as long as he pays for all the fuel, there is no benefit in kind. If he only pays for part of it, there is a benefit in kind, and any contribution towards the fuel would be ignored anyway. I thought that was a nasty one, if I'm being honest. Cool. Next one. Employee receives 50p a mile for using his own car for business miles. The payment will be subject to Class 1 primary and secondary national insurance contributions. True or false? Anyone for anything? Cool. Well, the answer to that is actually, it's true. The reason being, unless he's got a passenger, he's allowed 45p for the first 10,000 miles. But the 5p, as Robert says, 5p is actually a taxable benefit. And because it is convertible, well, it's not convertible into cash, it is cash. That bit will be subject to Class 1 primary and secondary by the employer and the employee. Why the employee would pay over, I don't know, give himself an extra bill. It's up to them. But because they're not paying the approved mileage rates, they're effectively getting some money. Yeah, I do think that's a bit nasty, really. Right, last one of these true-false questions, and we'll go and get our calculator out. Yeah, it's a tricky one, that. So Joe receives a salary of £75,000, building society interest of 1,000 and dividends of 2,000. He will have no tax to pay on the interest or the dividends. Is that true or false? Yeah, I don't think anyone's falling for this one. The answer is this is false, because the dividend allowance would cover the dividend, so he wouldn't pay any tax on that. But it would be taxable, but just taxed 0%. However, the issue is his salary of £75,000. He is going to be a higher rate taxpayer. Therefore, as a few have pointed out, his savings allowance is going to be reduced to only £500. So obviously the £1,000 that he's got there, half of that is going to be subject to income tax of 40%. So he will pay tax on that. Cool. Any questions on those four before we get our calculator out? Right. Let's have a look at this one. So Archie receives a salary of £55,000 and a bonus of £15,000. A bit of all right, is that? Now, his employer suggests that rather than taking the full £15,000 cash bonus, they give him a £10,000 bonus and pay £5,000 into his pension scheme. Just as an aside, why might his employer suggest he does that? Being cynical. Well, I mean, they're going to put £5,000 into a pension. Vicky's the one. That's right. So there is the tax, Sheila, is borne by the employee. They don't care about that. But from the employer's point of view, they would pay class one. So they pay class one secondary on the £15,000 bonus. Whereas if £5,000 went into a pension, occupational pension, pay class one secondary on the £10,000, but the company pension contribution is an exempt benefit, so they wouldn't pay any class 1A. Just as an aside. Anyway, but what we're looking at here is the tax saving for Archie. So Archie would be taxed at on the full 15,000, but like I mentioned, if £10,000 going to be taxed on, but £5,000 is an exempt benefit, so he wouldn't pay any tax on it either. Also, there'd be an NI saving for him, but that's by the by. We're not looking at that. We're looking at income tax. So there's two ways you can do this. You could work out a salary of £70,000, take off the personal allowance, calculate the tax, whatever it is. So you'd have to do postal allowance, basic rate band, high rate band. And then you could do the same thing again, but just on the £65,000, again, take off the personal allowance, basic rate band, high rate band. You could do it that way. But the other way of doing it is in a situation like this, and it works in this question, is rather than working out what tax he would pay on one and what tax he would pay on the other, actually work out what is the tax not being paid. So the tax not being paid is just the £5,000 that has gone into his company pension, which otherwise would have been taxed at 40%, which will be £2,000. So rather than working out two separate tax calculations in this, you can just take off actually what is not being taxed. So the tax save, which gives us £2,000. It doesn't always work, but basically if it's one person in one scenario, basically just what there's got two things. Either the amount of tax they pay is going to increase, so just look at that bit, or the amount of tax that they're going to pay is going to decrease, so look at that bit. So that works when it's one person. Any questions on this one? Right, the next one is not as straightforward. So Jack and Jill are married. Jill earns a salary of £190,000, additional high rate taxpayer. Jack earns nothing. So Jill also received £35,000 in rental income, and neither have any other income. So the issue here is we've got two people, so we can't be quite so clever. So basically what I want to see is, because they're a couple, basically, what tax would they pay if Jack receives the rental property versus what tax would they pay if Jill receives the rental income, I should say. So actually what we could do again is work out Jill's total tax bill and then work out Jack's total tax bill, and the difference would be the saving. But we don't quite need to go to that nth degree. What we can do is work out what would be the tax and just focus on this £35,000. So if Jill receives it, she's going to get £35,000 taxed at 45%, which is a figure of 123 times 0.45, figure of 15,750. So that's scenario one. That £35,000 will be subject to tax at 45%. That's that. When you do scenario two, Jack gets it. Now we need to be, there's a little bit more to do here because Jack's also going to get a personal allowance. So it's going to be £35,000 less the 12,570 gives us, what does it give us? 123 minus 12570, figure of 22,430. And then that's going to be taxed at a rate of 20% because he has no other income. So that there is clearly covered by the basic rate band of 37,700 times 0.2 gives a figure of 4,486. So what we want is the tax saving, which is the 15,750 that they would have paid on that 35,000 that, or the 4,486 that Jack would have paid of that, which is 15750. I'll come back to that question because that's a very good question. Equals a figure of 11,264. So the reason why we didn't worry about Jill's personal allowance is because we're looking at, the top slice of income. So Jill's income, is a mega amount of £190,000. That personal allowance, there's two reasons here. A, she's not going to get a personal allowance, and B, either way, you can either, she can get that income and it will be taxed at the top rate because her other income is already using the personal allowance. You can't say that she getting a personal allowance and we're saving any money on their income. That 35,000 is going to her, it's being taxed straight at the top rate. Whereas with Jack, he has no other income. So in this case, two tax savings, personal allowance that's not being used, remember, use it or lose it, and pay a lower rate of tax. So here we want to, we've looked at what tax is would be lost if Jill didn't get it, and then what would have to be paid if Jack got it, rather than working out the full, because the 190,000, that income of hers is not going to change. There's no, we don't need to worry about what the tax will that be because that will stay the same. We only want to look at the difference between, so in Jill's case, what is lost in taxable income and what is gained in Jack's case in taxable income. Does that explain why? So you can work out all these different, full tax comp, but if you're careful, you don't need to. You just need to worry about. So with Jill, we only focus on, her tax bill is whatever it is. We've not been asked for that. What we've been asked for is what tax would be saved by Jill. Now, and as mentioned, she won't get a personal allowance anyway, but either way, she'd still be paying. It doesn't matter whether her non-savings is going to be £225,000. If you take, even if you put the personal allowance against the property income first in her big calculation, if you take that off, it's going to be replaced by her salary getting the personal allowance. So either way, she's some of her income is taxed at the personal allowance, so her personal allowance isn't changing. The only thing that's changing is her income has fallen from 225,000 to 190,000 pounds. So that top bit between 190 and 225, no matter what it is, whether it's salary or in property, whatever it is, it will be taxed 45%. So that's what she lost, income from 225 to 190. And then we look at Jack's income, what he gained, which is 0 to 35. And obviously the first bit would be a personal allowance. That being said, if you don't want to sort of do it that way, it's not the hardest, most onerous calculation to work out what would be the total tax bill in situation 1, and then what would be the total tax bill in situation 2. But in situation 2, you would have to calculate 2. So you have to calculate Jill's less than £35,000 and then Jack's with. So if you can just work out what did we lose in scenario 1 and what do we gain from another, it saves you a lot of time. Cool. Right, next one here is capital gains. So there's 3 questions on capital gains. One of which is a share pool, which that's a job for Monday. So this is about capital gains tax principles. This is 10 marks. So the last one was worth 8 marks. So we've got 12 minutes to do this. Now, obviously you won't get that in the exam. This is an automatically marked question. So there's going to be some true, false, pick the right answer, and some calculations as well. So let's go through these. First one, Abigail sold a painting for £5,400. It originally cost £4,900. This would be a chargeable gain of £500. Do you think it's true or false? Yeah, I think you all got this. It is false. It is a painting. So it will not say this, but when you see painting, you think that's tangible, that's movable, that's a chattel. And then we've got our £6,000 rule. So the proceeds are below £6,000. The cost is below £6,000. It is going to be exempt. Next one, disposals to Abigail's grandmother would be at market value. So here we're getting at, basically, is Abigail's grandmother a connected person? Yes or no? Yeah, you are right. This is true. So because this person is a connected person, we would ignore the proceeds, if any, and would deem the proceeds to be market value. Now, remember, with connected people, you can go up 2 generations, you can go down 2 generations, and I need to get a better phrase, but you can go sideways 1 step. So you've got your parents, your grandparents, and you've got your children and their spouses, and your grandchildren and their spouses. What you can then go sideways is you've got your brothers and sisters and their spouses, but not cousins. Nothing. And there's also business partners in there, but that will not come up. Cool. Next one. Abigail made a loss on a disposal to a sister. She must offset that loss against a current year gain made against a disposal to a father. True or false? Yeah. I don't know why I was going to cross it out, but yeah, it is false. If you make a legitimate loss, remember using market value, against a gain, well, a transaction made with one connected party, that loss can only be used against that very specific party. So if you do lots of wheelie dealing with your family, you would have to have a loss memorandum for every single individual that you've ever had an capital loss against. You can't just have one general loss memorandum. Last one, the max amount of deemed occupation for PPR when self-employed overseas is 4 years. Is true or false? We've got a true and we've got a false. We've got another true. Remember in the exam, you got 50-50 chance, so you want to be put, don't believe in these blank. Cool. The answer to that is it is true, and the reason being is because this person is self-employed. So the rules are less generous for self-employed people because they have more control over where they work. Whereas if First Intuition said to me, do you want to go and set up FI Bahamas, I would say, well, if I have to, and I would go and do it. Whereas if you're self-employed, it's you choosing to go and set up something in the Bahamas. You've got a lot more say. So you only get 4 years before HMRC say you should really be buying a house out there because you chose to live out there. Whereas, you know, if the government made you the ambassador to North Korea, probably not looking to buy a house out there. You'd probably be deemed to PPR, and you'd keep your main residence in the UK. And as soon as your employment finishes, you get home if you can. So yeah, it is slightly different for the rules for self-employed. But to claim this, what must there be? So we only get this exemption if certain things have occurred. Anyone? You're along the right lines. Yeah, there must be actual occupation before and after this period. Now, it doesn't have to be directly before or directly after, but there must be some actual occupation at some point. If whoever it is did not return to this property after the 4-year period, they wouldn't get any of this allowance. You've got to have that. Cool. Right, time to get a calculator out again. That's what we want in our life. So Julian sold half his field for £80,000, and the remaining area of the field was deemed to be worth £60,000. It originally cost £28,000. So that £28,000 was for the whole field. Now, for reasons which I will not go into here for experience sake, we need a way of calculating how much of the original £28,000 was paid for the half that was sold. And we don't base it on the size of the field, because fields vary in quality depending on where they are and what they're adjacent to and whether one's boggy. And you might pay more for the field for one area than another. Anyway, so we're going to base it on market value. So the calculation, which uses a formula you will need to know, is the original cost, £28,000, multiplied by the market value of the bit that you've sold, which is, we know that, which is £80,000, because that's the proceeds, over the market value of the bit that you've sold, plus the market value of the bit you haven't sold. So they've got to give you this in the question, or you can't do it, which was £60,000. So 80 divided by 140 is a nice, it is 140, isn't it? Times by £28,000, actually it's quite a nice figure, gives us a figure of £16,000. So that is the cost of the bit that we have disposed of. Does everyone see where I've got that from? Cool. So, but this is a bit I see time and time again. I saw one the other day in some of your assignments. So that is the cost. So you do all that calculation, think, oh, brilliant, but that's not it. We've been asked for the capital gain. So the gain is a relatively simple £80,000 less the cost of £16,000, meaning we've got a gain of £64,000. Don't give the cost when we're actually looking for the gain. But that is the formula that we need to use for part disposals. And it's not just fields. It can be if you bought a set of paintings, you paid £10,000 for 3 paintings and you sold one of them off for 4,000. It can be furniture if you bought, I don't know, a set of 3 chairs, dining room table and 4 chairs, and you sold one of the chairs. Just watch out for when you've got one price for lots of things and you've sold part of it off and you've still got some left, and it's a part disposal. Cool. Right. Last one, we've got a holiday home which is never lived in. So we're going to calculate the gain, but what rate of capital gains tax would we be applying to this if we've been asked to calculate that? I don't think it gives you in the reference material. So what are the two tax rates we would be using for this? Anyone for anything else? Now, the answer to that is actually, it would be, I'll give someone else a chance, it would be 18 and 28. Does everyone remember that? Because it is a holiday home she's never lived in. So it's a residential property and it wouldn't get PPR. So remember, the government don't like landlords so much nowadays. So there's a higher rate of capital gains tax on residential property. Now, we haven't been asked to calculate the gains on that, but just watch out for that, because I'm pretty sure it's not in the reference material, those rates. Yeah. It's probably right at the bottom, it's gone way past it. No, I didn't think it was. No, so just watch out for they're not in the reference material. So, well, any question where there's at home, and if you've got a PPR question, it's still going to be subject to 18-28%, but not all of it, because she's got some deemed or actual residence. But whenever you dispose of a home, not commercial property, but a home, the rates are 18 and 28%, and they are assessable. Anyway, we've not been asked for that. We've just been asked to calculate the gain. So the gain would be the proceeds of £500,000. Then we can take off any costs of sale, which she had 2%. So 0.02 times £500,000 is a rather expensive £10,000. This gives us a figure of net proceeds of £490,000. We can then take off the original cost of £140,000. So we dealt with that. Next, we've got, she spent £25,000 on an extension. Are we going to allow that or not? Yeah, because there wasn't an extension there before. So she's enhancing the value of the house. So you've got enhancement expenditure of, what was it, £25,000. We dealt with that. What about replacing the kitchen? Are we going to allow that? Yeah, the kitchen was there. It was previously just replacing it. So we are not going to allow that. And then lastly, the roof. Again, yeah, we're not going to allow that. That is just maintaining the value of the property. So that's another 165 that will come off there. So we'll take our net proceeds of £490,000, take up 165, gives us a gain for capital gains tax, obviously, of £325,000. Cool. Any questions on anything we have covered so far? Any of this anyone wants me to go over again? It's only 18.2. Any questions on anything related to personal tax whilst I'm here, or AAT in general? Yep. Right, 7B. Which question are we on? This is 7B. We'll do 7B, and then you can type your answer out, Lewis. So here we needed a way of prorating the original purchase cost of the field, because we might have had a field that was half of it's next to a housing estate that's clearly going to get planning permission on. and then the other half might be a wet boggy field that no one really wanted. So you paid £28,000 because you knew that half is going to get planning permission. So the lion's share of what you paid for it will be based on that portion, not on the proportion that's all boggy. So we will value it, we'll allocate the original purchase price on the value of it. So that is the current market value, i.e. the proceeds, because we know what it's worth, it's on that, over the current market value plus the value of what is left. Multiply that by the original cost, £28,000, gives us a cost of the original purchase that for the part that we've disposed of is £16,000, and it's just a normal disposal. Cool. Right, Louis, you're going to write your question. Suzanne, I've got an answer for you for that. Give us a second. Wrong link. I'm going to get you it. Where have I gone? The income tax pro forma. Yeah. Without being big-headed, I'd do it my way. I just think that basically, as long as the marker can follow you, that's totally fine, and it's clear and it works for you. But personally, I like doing it my way. It's entirely up to you how you do it, but as long as it's clear and the market can follow you, they've got to give you the marks. Cool. Yeah, I can give you Mondays. I'll give you it here because A, I've got it, and B, if you watch it on YouTube, it bumps up our views and we become as big as Mr. Beast. Maybe. So that is Monday's video, task 3 and 4. Yeah, and today's, when I stop sending it out, will go out in we'll go out tomorrow morning. So I won't do that. Cool. Anyone for anything else whilst I am here? If not, if I don't, well, hopefully I'll see you 6 o'clock on Monday, which is our last one, where we're going to do tasks 8, 9, which is capital gains tax, one of which is shares, and task 10, which is inheritance tax. I don't know why I know that. But if you've got an exam between now and then, good luck. If not, remember we're here to help, and I'll see you on Monday night. Cool. Right, good night, everyone.